Okay, good afternoon, everybody. Welcome to the session that's going to be focusing on investing in Africa's future, supercharging venture capital interest. My name is Yandile, and I'll be facilitating the session. May I say all protocol observed? Okay, so we can start with our session. I think, Mareme, maybe you can start by briefly introducing what it is that you're doing, the portfolio that you have at 500 Global, and then we'll get to you, Janade, as well. You can start.
Good afternoon, everyone. Oh, sorry, that was loud. Good afternoon. 500 Global is an early-stage venture capital firm. We are based in the US, primarily investing in emerging markets all over the world. We've now invested in about 135 companies here on the continent, and we've had the chance to invest in some great performing companies like ChipperCash, MaxAb across the continent. So we're very excited to be here and chat further about how we can build more interest for VC on the continent.
Thank you very much, Janade. What about yourself? You want to tell us a little bit about what you're doing at Launch Africa Ventures and 535 Ventures?
Yeah. Good afternoon, everybody. I am the co-founder of two seed funds. One is a Pan-African early-stage fund called Launch Africa Ventures. The other one is 535 Ventures, which is a seed-stage female-focused VC fund. We started this journey in October of 2020. Launch Africa has since invested in 133 companies in 22 different African countries. We have one investment here. One of our star performers is Alpha Direct, where we were the institutional investor in the early round. And in our female fund, 535, we only launched last year in June, and we've got 18 investments in 9 different African countries.
Okay, thank you so much. I think offline we were just having a conversation around the difference between SME investing as well as startup investing. Interesting stats coming out of 22 in Africa. About 75% of funding deals are going towards only 4 markets in Africa. That's South Africa, Egypt, Nigeria, as well as Kenya. And of those 4 key markets, about 3.5 billion went to those markets, and around 531 deals came through in 2022. Now, when stats like this come into play, you want to understand, well, what's currently happening in Africa, but also how can we spread these investments across other African countries. Let's start first with the conversation around SME investing and startup investing and what the key difference is. Any one of you can go first.
I think one of the conversations that we're having, and especially I think it's relevant to some of you who are present in the audience, is that today when we're talking about early stage investment, there are 2 different types of companies that we always refer to. So startups and SMEs. And those 2 businesses have similarities, but also have some very strong fundamental differences. And those differences are even more relevant when it comes to sources of funding. Because us as venture capital investors, we primarily invest in tech startups. That means that when we're looking at a company and assessment of an investment opportunity, we are looking at key factors that make a small, medium company grow at scale, leveraging technology to do so. And that creates a fundamental difference in how we look at both SMEs and startups, because a lot of companies who actually come to us as VCs are SMEs. but they are SMEs that are using technology. So they don't necessarily have the same model for growth, and neither do they use technology for the same reasons that startups do. So one, when it comes to sources of funding, it's quite critical to understand the differences between the two. And second, when it comes to even the form of financing itself. We were talking actually earlier backstage about the fact that venture capital is equity driven. So it means that we are taking equity parts in a company when we are investing capital, whereas SMEs often are actually in a better position looking at other forms of financing, whether it be related to loans or grants or working capital, because their financial needs are just significantly different.
Okay, Janade, do you want to add anything to that?
Yeah, we were saying earlier that the key difference is also mindset of the entrepreneur. In startups, the entrepreneur grows the business in order to exit, right? You're looking for that exit. In SMEs, it's all about profitability. I have a psychology background, so I always try to relate things to the human experience. I always say that SME kids went to public school and the startups went to private school, right? Very different in terms of their approach to education. And so we all quote these numbers, but that only relates to startups really. And we were saying backstage is always follow the money, right? The money that you are hearing about, 6.5 billion, all relates to mainly tech startups. But actually SMEs are the engine of growth for every economy in Africa. And we need to be investing more in SMEs. But it requires lots of government intervention, corporate engagement, and investors changing their mindset. Currently, like was mentioned, we're focusing on equity. But equity is often the worst financial instrument that you can put in an early stage company. Typically in Africa at the seed stage, companies are raising around 1 million or 2 million. When you break that down for an SME, it should really just be 500,000 of equity, 500,000 of working capital, which is actually what most SME needs, and debt. And debt in Africa is often the scary thing. But the thing about debt is it teaches financial discipline. So we need more holistic approaches to financing in order to fund more SMEs in Africa.
Do you think there's a need to pivot, or what have you seen in your fields for SMEs to pivot towards a startup-oriented model for growth, and as well as the business models? I mean, realistically, we just really did emphasize that, but most of the funding and money is going to the startup space versus the small, medium enterprise space.
I think something that we have to be very careful about is that these funding numbers should definitely not encourage a lack of focus on SMEs. I think that, you know, part of what's getting lost in translation is that the entire conversation around startups is making perhaps or creating a feeling that SMEs should necessarily convert into startups. But like Janade said earlier, SMEs are actually the backbone of every high growth economy that you see. And as a matter of fact, a lot of the tech companies, even in more mature markets like the US, are based on economies that have a very strong foothold on SMEs. The US is actually one of the countries that has the highest growth of SMEs in the world. And that is because SMEs, at the end of the day, are some of the main customers for startups. So how do you build B2B models where you don't have B2B companies to serve? So, you know, a lot of the funding conversation is around startups, and there is a need for startups because today we need to be able to leverage technology because we are an emerging market as a whole, and we need technology in order to make sure that we can leapfrog and also we can address some of the very critical issues that we have in some sectors like health, like agriculture, like education. And technology allows us to do that at scale. However, that does not mean, and that does not say, that SMEs have to become startups in order to be successful. We also need successful SMEs in order to have successful startups.
Okay. Okay, let's move to the VC space now for the startups, because that's the center of the conversation. Let's talk about the deal sourcing process. having an investable or bankable startup pipeline across the continent that is lucrative enough for the both of you to invest in. What are you experiencing in the market in terms of key challenges and the deal sourcing process, finding bankable startups across the continent?
So we invest at the seed stage, typically in Africa or in any VC value chain. You would have an idea as a founder. You would use friends and family money. In Africa, we don't have that. You have to use your own money, so you're hustling. Then you would find an angel, somebody that believes in you and your idea. Also in Africa, that's quite limited, but it is growing. So you find really, but it's very city or regionally focused. Then you would go through an accelerator. And in Africa, actually, we're quite blessed because there's about 76 accelerators, very good. And they take startups through a rigorous process of product market fit, trying to get your first customer, and just ensuring that your organization is structured in the right way. And then we come in where we engage in, which is at the seed stage. But at that stage, what we look for is, I often say to our team that more than likely we are backing the jockey more than the horse, meaning that you are backing the founder and his or her idea, and how his knowledge of the market, how he or she is thinking about the business, and how he is able to put the right team together, how they are able to put the right team together. Founders typically in Africa are actually higher qualified than in other regions. We've done a bit of research in 2021, interviewed 350 founders from different regions. And we typically find that in Africa, founders are very educated, skilled, has corporate experience, and also a little bit older than their counterparts in other emerging markets, right? Then there's the ability to show traction. And that is, how have you engaged with your market, your potential clients? What is the problem that you're trying to solve? Thereafter is the product. Product is, you're only as good as your product, and therefore, how have you built your product? How have you built your MVP? What are the project features? What makes African startups quite unique, especially at these early stages of our VC, and typically we've only been doing this for about 10 years, is that African founders are solving real-world problems, right? And so certainly in our fund, we have this archetype of an African mama. And that African mama, whatever investment we do, is it has to solve for that African mama. So how is she paying for her goods at the market? How is that goods getting to that market, right? How is her kids going home? How is she paying? How is she ensuring that there's enough electricity in a home, et cetera, et cetera? Our archetype drives a lot of our investment decisions, right? On the DD side, what we've found, though, is often founders are not prepared, right? So I often say to founders, there's just running any business, whether a startup, SMEs, you should be doing your accounting, you should be doing your management reports, you should be doing the basics that any business should be doing. You should never allow an investor to be asking for those things. That already is a red flag. So, there's a response. Every investor has got a DD deal list, but there's a responsibility as an entrepreneur for you to run your business. So make sure that your books are in order, to use SME talk, and also ensure that you have a data room, and the data room is complete, so that investors don't have to come back, right? Do your research about investors, right? I always think that as much as you're chasing capital to fund your business, use the opportunity to interview investors. Ask when was their last, ask whether they have capital. Please ask them during this difficult time. A lot of funds don't have capital to invest. Whether they have capital, what was the last deal that they've done? How have they added value post-investment? Probably the most important questions. So it's your chance to get to know your investors as well. Then thereafter, make sure that you use your investors as a strategic enabler. They should be, if they're investing, they should be able to introduce you to enterprise customers, They should be able to introduce you to new sets of investors. They should be able to open new markets for you. It's a relationship, and therefore you can't just have the capital relationship flowing one way. Investors have to work as hard for you as you are working to return their capital.
Okay. I don't know if you want to share anything, Mareme, and as particularly around the due diligence phase. I know you had some interesting thoughts around when should a startup begin thinking about compliance and having the right documentation. You want to share a bit of your thoughts around that in terms of your experiences in this field?
I mean, something that we often see, especially with, and we've seen examples of African founders quite a lot, where they start getting their books in order when there is big money coming in. So when they get to maybe an A, perhaps a B or C, that's when they start bringing in accountants. That's when they start actually putting their books in order. Something that often they don't realize is that the due diligence stage at that moment also goes back all the way to inception. So investors want to see what exactly happened in this company since it was founded up to today. And often the documentation is lacking. Another example, a lot of African startups don't have IP agreements. Not IP agreements with themselves or their employees or their consultants. And that, especially for product-led companies, that creates a huge liability if you actually cannot prove that the IP belongs to the company. So, you know, a lot of it comes from the fact that it is a growing ecosystem, and we are learning as we're building, but I think we need to have honest conversations about what does it take to build best practices. And we need to be able to be honest to each other about, especially for early stage companies, what is needed to make sure that these companies are in order from inception all the way to exit. And especially because a big driver for exit is that level of rigor, and really that rigor of transparency. And as Janade actually mentioned, an investor relationship is like a marriage. You want to come into that relationship with as much transparency as possible. Do not think it's a good idea to be hiding things from your investor, because that person, that investor, will be your #1 cheerleader all the way to exit. So if you're coming into that relationship already with hiding facts, hiding documentations, you are setting yourself up for failure. And we've seen this times and times again, where companies that are doing great with great traction, but that just do not have the accountability and the transparency to be able to actually document that growth. So definitely on the due diligence side, that's something that I would emphasize on. And then on the founder's side, something that we look for, and something that I look for personally, is I look for founders who are more in love with their problems than they are with their solutions. Because entrepreneurs think about their solution as being their project, their babies, they focus on it, they obsess about it. And the reality of the market is you will have to pivot. The solution will change, will grow, will adapt with the market. And founders who are more obsessed with the problem that they are solving are a lot more open and are a lot more ready to actually adapt and change the market, because their focus is truly on the problem that they are trying to solve and not the solution that they found for it.
Okay, so we've spoken about the deal sourcing stage, the due diligence stage. Let's talk about the startups then that reach the investment decision stage, where you decide that you're now going to invest, and we start to talk about structuring, deal structuring. Janade, I think I want to hear your perspective on this. I don't know how true this is, but you've traveled to about 50 plus of the countries in Africa. You know, having been so exposed to the African continent, how has this influenced your approach when you're engaging African startups and when you're now structuring the deals with them?
Yeah, you know, Africa is a big continent. We have 1.4 billion people, 54 African countries. But if you really break that down, it's actually really 5 or 6 different regions, right? So certainly at our fund, we are very optimistic on Francophone Africa at the moment. 440 million people, common currency, same central bank, same laws that governs, and a currency that is pegged to the French franc through the euro, right? And let's compare that to Europe, right? double the amount of people, 750 million, so many countries with their own laws, although government under the EU, language differences, etc., etc. You can break that down into Arab and English, North Africa, English, East Africa, which as a block are working together, and certainly Southern Africa, right? And so when we help companies scale to different markets, which is what we specifically do at the seed stage, it is challenging because there are nuances between countries, but actually from an investor perspective, we are able to engage with our corporate partners, which is often Pan-African, and we are able to engage through our local investor networks. So we have not actually found that difficult to expand, right? There are nuances. Southern African founders very reluctant to go to the rest of the continent. Nigerian fintech founders stay in Nigeria for longer because you've got over 200 million people to serve, right? And so the region, the type of business, where they are in their traction, really determines how much we would invest in the dollar amount, right? Our approach to investing is we want to simplify the seed stage, and we also want to bring uniformity to VC. So what we went and did is we predominantly only invest through safe notes. Safe notes, typically in Africa, VCs take 6 to 9 months to make an investment decision at the seed stage. Now, which seed stage company has got cash flow for that long sitting in the bank, right? They should, but this is not the African reality. And so what we wanted to do is decrease the investment time to 4 to 6 weeks. So we decrease the time. We use one instrument, safe notes. Safe notes allows the negotiation to be around the valuation and reduces all the other terms. And we give a quick yes or no whether we want to invest in a company. It's different in different regions and in different sectors. We're finding that higher valuations currently in fintech, and rightfully so. I love when ecosystems mature. Nigerian fintech founders are raising seed valuations at 10 million plus, right? And the e-commerce platforms, transport and logistics, healthcare, and will follow, but their average valuation sitting around 5 or 6 million at the moment, right? And so, that's a difference between West Africa and East Africa. And so you have to understand the regional nuances. A lot of what we do is work with corporate enterprise customers to allow us to engage with them to see at what valuations would they look to acquire these companies, right? Because that drives almost the multiple that we would invest in. So at fintech West Africa, we are looking at a 10 times revenue model, for example. We might not do that in transport and logistics in East Africa. So as an investor looking at Pan-Africa, you have to understand the regional nuances, but you also have to understand how the sector's difference between the two.
Up. 30 seconds quickly. Somebody is listening in. What are your focus areas as venture capital firms where you're currently looking to invest in?
Building solutions, like I said, that are rooted in real problems. There is a true path to scalability, and especially if they're solving a problem that is relevant to the rest of the continent. So not just to their single country, but where that solution can also be applicable to other countries on the continent, because as we see on a regular basis, it does create very little defensibility to just be in one market, because we all know how unstable these markets are and how much the cycles go in these markets, both on the economic side. So we have to be looking for companies that can scale.
So you're not sector specific or sectors?
No.
Okay. Yourself?
Yeah, also country and sector agnostic. We are, in July this year, we're launching our new fund, a 75 million seed fund, similar to what was just said. We consider ourselves as the frontier fund. We're the only fund in Africa that is now invested in 22 different African countries. I would love to make that 30. So we are looking for those market opportunities in other regions where we are not. We've already invested in Botswana. I would love to do 2 or 3 more investments in Botswana. And so if you have a seed stage company locally that you think that you need to introduce me to, please introduce me to.
Gentlemen, thank you so much for joining me on this panel. Thank you so much, ladies and gentlemen.